LGT is a mid-sized accounting firm located in Uptown Dallas, and we serve our clients' needs in taxes, auditing, and assurance services. In 2021, LGT will be providing over 60 hours of CPE, so we hope that you'll join us for future events as well. Before we get to LGT's presentation, we have a great speaker joining us from Northern Trust. Chris Gold is the Senior Managing Director of Dallas Wealth Management, where he leads a team who specializes in investment management, wealth planning solutions, private banking, and fiduciary services. Chris has worked exclusively with ultra high net worth families for over 20 years in all areas of wealth management. He was on the editorial board of the New York Times #1 best-selling Ernst & Young Tax Guide for 4 years, and he is celebrating his 12th year at Northern Trust. Please welcome Chris Gold.
Thank you so much for the kind introduction, Katie, and thank you all for joining us today. I'm honored to be with you this afternoon, and like many of you, I look forward to David's update after my comments. As Katie mentioned, at Northern Trust, we work with families and institutions, and the introductions usually come from one of 4 set of circumstances. Corporate executives who are seeking clarity on guidance on optimizing their benefit offerings or their concentrated stock positions. Multi-generational wealth that will or has been transferred to new family members. An individual who has unexpectedly become single, whether it be through divorce or death, or business owners like yourselves who seek advice to optimally run their businesses and prepare for eventual transitions. And I can only imagine what you all have been through over the last 10 to 12 months with so much uncertainty with COVID and the changing environment of the economy, the fiscal policy changes, the economic recovery, tax policies, vaccination policies. And so our focus here today is to kind of talk to you about how to optimize your business while being very mindful of the different individuals that may benefit. It doesn't only include you all, the owners or the operators, but sometimes the founders, the employees, family members who may be some or all of those categories, and then also new ownership groups. At Northern Trust, how we try to advise families and business owners is to define goals and manage towards them. And I think it's really important for us to start thinking about goals. What are we looking for in the future? What are going to be your objectives? In my short time with you today, I'm going to concentrate on a few blind spots related to planning, which we've worked through with other business owners such as yourself. And we're going to try and provide some tips that you can implement that will save you and your stakeholders time, frustration, and most importantly, capital. The 3 blind spots that I'm going to focus on today or offer some advice that you may be able to take into your specific situation are going to be estate planning, philanthropic planning, and income tax planning. So 3 subjects that just jump off the screen, right, towards everyone. So let's start with estate planning. If you don't believe you have a current estate plan, let me enlighten you first. The IRS has a plan already written for you, and they are there to take as much of a chunk as they can. And the thing is, if you or your spouse or your children or your children-in-law, if you guys disagree with any of the elements or the decisions in your estate plan, which I suspect you may have the ability to compose your own and offset the IRS's plan. I would ask you all to think about the last time that you reviewed your estate plan. If it's been a while since you last updated your documents, sometimes we run into business owners. They're so incredibly busy running and operating their business that they don't even know where their documents are. Lots of things have happened. There may be a change of ownership. Your business has grown. Your family has grown, or your family has shrunk. And so what I would tell you is, as you can see on this next slide, there's never been a better time to review your estate plan. And whether you're a corporate executive, suddenly single, multi-generational, or a business owner, now is the best time to review your estate plan. So let's talk a little bit about that. As you can see here, exclusions, lifetime exemption amounts have never been higher. They're currently at 11.7 million. So what does that mean to you? That means you have $11.7 million that can pass estate tax-free into a trust or to beneficiaries or heirs, and the IRS does not touch that. Any amount over that is subject to a 40% estate tax rate. So there's a lot of planning opportunities that go into that. And what I want you all to think about, if you see that high exclusion slide there, you can see what happened pre-tax cut plan from President Trump, how it sits right now and then what is probably going to happen in the future. You'll also have very low interest rates, which I think if you're thinking about a transition, whether it be a sale and or a transfer of your business, you should really focus on these low interest rates. So the question would be why? Well, the Section 7520 rate, which is a section of the IRS code, is the hurdle rate that a lot of the transfer strategies that we talk about with business owners has to beat or pay out to as you transfer an asset. So if you're thinking about, probably one of the most famous examples would have been the founders of Facebook, who had hundreds of thousands or millions of shares at a very de minimis price. Before they went public, they were able to transfer those shares or ownership in the company into different strategies. And the hurdle rate at the time, the 75/20 rate, was 1.25, meaning any appreciation over that 1.25% went into different types of entities for family members, into other trusts, et cetera. Meaning that when you had 10 cent, 20 cent, $1 founder shares, it went public, if you remember, at 37. I think it closed at 45. I'm not exactly sure where it sits now, but you can imagine that the rate of growth is so accelerated beyond that 1.25% that an enormous amount of wealth was able to be passed to family members and into other entities. And then finally, I would like you to focus on that uncertain tax future. And I know that you all are very aware of this, but the estate tax has really never been lower than it is now. I know that 40% of the operating business that you've created and what you've built or your family has built, and the idea of giving 40% of that away to the IRS seems high, but historically that rate, as you can see, has been as high as 75, 80%. It sat at 55% for an incredibly long time. And there's a lot of discussion about what is going on. Is that going to go up? Is that going to change? And so I would encourage you to think about the exclusion amounts that you can gift, the low interest rates that allow you to create strategies, and then finally where the estate tax rate is going. And what we've been telling people right now is you want to plan. We're not in the business of predicting. So what I would ask you to do is start thinking about how any of those are going to impact you and your family. What's funny about this, though, is there's also a lot of smaller pieces that are imperative when we talk about estate planning. Wills, trusts, beneficiary designations, bequests, guardianships, powers of attorney, healthcare proxies, pre-written management decisions, entity formation, company valuations. Each of these can impact you in an amazing way, and unfortunately can impact your company and your wealth in very unintended ways. A very present day example of what is going on would be a HIPAA form for any children that you have who are 18 and above. And without that form, you as their either guardian or their parent actually do not have access to their medical records if something were to happen to them right now. And this was often very overlooked, but you can imagine in the COVID environment, if you have children in college or in grad school, and all of a sudden they're hospitalized with the virus, that you as a parent actually don't have access to talking to their doctors because you don't have the HIPAA form. It's small little unintended consequences like that we try to guide our clients with, along with the complex strategies. There's also unintended consequences if you think about those large exclusion rates. It sounds great if you have a business and you can move 5, 10, $15 million without being exposed to estate taxes, but that may also not be your actual long-term plan. We recently reviewed some documents of a client that was drafted in 2008, which in the grand scheme of things was not that long ago. And in the document, it said that they wanted to fund their bypass trust to their surviving spouse at the maximum. Well, the issue there was at the time, that amount was $2 million and it's now $11.7 million. And that was an absolute not what the family intended to do. They had some other strategies along with that actually were not going to be able to be funded because that funding amount first was going to supersede the other steps in their estate plan. So again, you may not all want all your wealth to flow a specific way how it goes right now for a myriad of reasons. And then there's another area where we observe a lot of unintended consequences when we're only focusing on those complicated strategies, It's the small, small details. And I love to tell stories because I feel like they resonate most with you all instead of writing down a bunch of complex ideas. But I once worked with an executive who was absolutely brilliant, one of the brightest people I'd ever worked with, but very disorganized when it came to administrative paperwork, a bit of a procrastinator when it came to his own personal life. He went through a really tough divorce, and then he was able to remarry 5 years later. Well, unfortunately, he and his daughter were in an accident, and his ex-wife, not his new wife or children, actually inherited his IRA. The reason? He'd never gone back, found his IRA beneficiary form, and updated it. His daughter was the primary beneficiary, but his ex-wife, unfortunately, was the contingent beneficiary. And that, of course, is not an easy message to deliver to his widow. And I think something you may want to write down, always remember beneficiary designations on insurance policies, qualified plans, sometimes entity operating paperwork. All that supersedes what you may write down in a will or in trusts. Those documents have power over your estate planning documents. So make sure that they complement each other and that you reviewed them. Another thing to think about, a lot of times as parents, we purchase insurance for specific purposes, and then we kind of ignore it as our children age or age out and start their own lives. Well, many instances we've seen where there could be a child who has encountered trouble in their 20s or 30s, who you may not want to no longer be a beneficiary outright of insurance proceeds. And then you also have to think about if your children marry and maybe it's a little bit of a rocky relationship that they're having. And again, if they inherit that money from a life insurance policy outright, not in trust, and then they commingle that with their spouse by potentially purchasing a house, other types of things, and then there is a separation or a divorce, those assets are no longer in your family lineage, but they're going to be spread out among former son-in-laws or former daughter-in-laws. I would also tell you, so many times in estate planning, inaction is the common action. A lot of us don't like to think about our mortality. We don't like to think about worst case scenario. And so what we find in the wealth management world is this is probably the area that is most ignored or put on the back burner. Lots of discussion, but maybe no action. And I would tell you that the cost of inaction that we have noticed is it's not just monetary, but it's absolutely emotional. And it's one mistake that's impossible to correct, unfortunately, once you're gone. So whether you were working with a financial planner who's helping you with retirement, estate, income tax, insurance, investments, or you're working with your estate planning attorney, I would encourage you to engage and update all your documents. Discuss who should make decisions about the business as shareholders. For instance, do you have certain family members or individuals that you want as corporate trustee? And I'd love to share another story. A longtime client of mine was finally prepared to have the what we like to call what happens next conversation and truly begin the process of determining the next steps for her business. Provide you a little bit of background. Her father had started the business and she inherited the business at his death, but she was not a caretaker of this entity. She absolutely took it to the next level or the next level above that. And then she has 4 children of her own. And her oldest son was the first and coincidentally the only of her one of her 4 children that actually worked the business. And he was also an impactful employee and created a lot of meaningful value. The other 3 of her children all had solid careers and family lives outside the business. And the family dynamics between her husband, her 4 children, her 4 children-in-laws, it could not be more positive of a family of 6. And then she also had 9 grandchildren. So in the beginning, I referenced how we like to approach our planning, which is defining goals, which sounds simple, but when you're thinking about a legacy of your business and or your wealth, not as easy to do. Well, her main objective was to transfer the business to her children. Well, her oldest son's main objective was to have her transfer the business to him or to sell it to him in some type of strategy. Her other 3 children's main objective that was each one of them would inherit 25% of the business. This was a family unit that had love and respect for one another. Again, got along very well, but they found themselves up against it for the first time, probably since the 4 kids were in various ages of of being little kids, right, and fighting over toys and those types of things. And we found ourselves at a great impasse. We had one family meeting. It was as cold a meeting as you could imagine, because the oldest son didn't feel like he was disrespecting his siblings or his mom, but he expected to receive more because he worked for the company, right? And he could write down tangible ways that he had impacted and created value for this company. What he'd never had heard were his other three siblings explained that they felt like they were never provided the opportunity to work for the company, or in the family business, and that the compensation that he was paid needed to be equalized out among them. And I'm sure some of you have been through this, or you have friends or colleagues who've been through this. Why it's so curious to me, and why it underscores the importance of planning, is that none of them were wrong, right? And that's always what you find yourself in a very difficult position, right? No one had an incorrect opinion and needed to be convinced that they were right or wrong. They each had very valid positions. So we've talked in the introduction about blind spots. So we talked about the blind spots of your documents, or lack of planning, or not taking advantage of the high exemptions and the low interest rates. But I would tell you that the blind spot here, beyond highest price for the company, lowest tax rate, correct entity, collaborative partner, none of them had ever communicated about what they thought was next. And the good news in the long run is that respect and love existed. And along with Northern Trust and their estate planning attorney, were able to craft a solution that provided all parties a path forward. And I'm very happy to say she's retired. She's enjoying the wealth she created. The company is still thriving, still meeting plan, exceeding plan, and her children and her grandchildren all get along. But what you should take from that is, again, those difficult conversations need to be started. So start doing the planning, start thinking about what's next. As I mentioned in my opening remarks, there's so much uncertainty around estate taxes, step up in basis, the exemption amounts, combined with the sunsetting figures post the Trump tax cut, which happens to sunset in 2025. Now is the time to think about planning. So let me give you just two ideas in the estate planning environment that you could think about or consider. You should think about utilizing business valuation discounts. One of the most powerful and impactful ways that you all have to plan is with discounts on the valuation, moving it into a partnership or moving it into a trust, that lack of marketability. So from an estate planning perspective, you guys have historically applied valuation discounts for lack of marketability, lack of control when you're transferring your business interests to your heirs or to other employees. Applying these discounts is going to allow you to transfer shares of the business out of your estate at a lower value. So there's more bang for the buck with those large exemption amounts. And you have more left over to potentially move other assets. But what you need to remember, and this is not a political statement, but in the 8 years of the Obama administration, it was always on the top of the agenda to have a proposal to restrict the use of valuation discounts for transfers of interests in family-controlled entities, specifically small business owners and entrepreneurs. There's a strong possibility that the proposals could be revived. Again, we're not here to predict, but we're here to plan. So what I would ask you to do is probably consider revisiting your ownership structure for your holding business interest and your other family assets. That includes FLPs, family limited partnerships, sorry for the acronym, and utilizing valuation discounts where appropriate. The second idea that you might want to consider would be creating some optionality for yourself as we plan, not predict, and setting up some GRATs now that you might be able to use later. So GRATs, for those of you who aren't familiar with them, that's the acronym for a grantor retained annuity trust, a very common estate planning technique that if you structure it properly, it's going to allow you to transfer assets into a trust for your beneficiaries, children, grandchildren, while you pay little to no gift tax. If you think back to the earlier slide of those lower 75/20 rates, GRATs, the hurdle rate is that rate, which right now is at 1%, meaning you have a company, again, maybe let's just call it $10 a share. You transfer it into a grantor retained annuity trust. You then sell your company at $100 a share. That $90 per share, we're going to be able to take an annuity payment back for a period of years, and then leave the rest of the asset in a trust for your kids or grandkids. However, there was a strong proposal from the Obama administration that proposed curtailing the use of grants. No legislation was ever enacted, but I would argue that if you plan for the possibility of these proposals, that they could be revisited. You can set up grants with your estate planning attorney now and not fund them. Okay. So you might create a grat with a 5-year term and fund it with certain amounts of cash, and then it would pay you an annuity back for those 5 years. And if legislation is ever adopted that curtails or eliminates the ability to use grats, or if potentially there's an interest rate hike that makes it not as appealing, the grat that you created is grandfathered in, right? So then you could actually swap assets. So it would be very important as you were doing your planning that you had the ability to swap assets, and you could take that cash that was inside there, move company shares or move part of the company into that, right? For the cash that was inside, and then transfer the value of your company to kids or grandkids. Again, it would be important to have that in place now. What's very interesting, a lot of times, the IRS does not view post-transaction transactions and or planning after the fact very favorably, right? So there was a mad rush at the end of 2020 with the idea that there would be a potential change in tax rate, exemption rate, the ability to use grats at the end of the year. So you want to be ahead of this curve instead of behind this curve. Philanthropy is a second blind spot that we run into very often. And my argument to you all is that it can actually benefit you and your family more than it benefits organizations that you might support. It can play a massive role in your estate plan if you're so inclined. The majority of business owners that we engage with are very, however, uncertain how to imbue many times into their beneficiaries, their desire, for charitable giving. What's interesting talking to you all in this audience is that we have tons of data, numerous studies that show that people like you are a lot more philanthropic minded on an annual basis, and you volunteer a lot more than your peers, maybe those corporate executives or other people in the business community. I could argue that's not a surprise if you would think about John D. Rockefeller, Andrew Carnegie, 100 years ago, who kind of created that idea and mindset, all the way, if you look to now, Bill Gates, who's dedicated a large portion of his wealth into giving back. And there are a myriad of strategies that you can execute on if charitable planning is one of your objectives and goals. But again, that would first take a conversation about what you wanted to actually have occur. I try my best not to use acronyms, but there are CRTs and CLTs, which are charitable remainder trusts and charitable lead trusts. And the remainder and the lead are the key words in each one of those descriptions. With a charitable remainder trust, you would be taking income back for a period of years. And at the end, the assets that are left would go to the charity. What we see most often with our clients is a charitable lead trust, which means you're making a donation into this trust. You're receiving credit for it from an income tax deduction perspective. So a lot of times we see this in year of sale. And let's just say, to make it easier for me, you put $1 million in there and it's a 10-year term. But what has to happen then is there's a calculation, and every year for 10 years, there needs to be a donation to specific charities, right? And all the investment return over that 75-20 rate that I talked about earlier stays inside this entity. So then at the end of the 10th year, when your trust has made all the distributions to the charitable organizations that you and your family are connected to, the assets that are left can stay in trust for kids or grandchildren. It's an incredibly powerful tool. What it also allows you to do is monitor the organizations that you're connected to. So many times we see a leadership change at a university or a specific organization, and potentially the mission statement changes and it's not in line with what you and your family necessarily want. This can provide the flexibility to change beneficiaries and not lock yourself in, which unfortunately we see sometimes in bequests in your estate plan. But a lot of times we know that our client, when they pass away, the connectivity or the alignment does not exist anymore with the organization, but they never went back and updated any of those death bequests. So what I also love is you can also create, besides these types of strategies, a family foundation, which includes board participation. Um, you see this with maybe the Gates Foundation at a very large level, but we would argue that if you had even $5 million, depending upon the value of your company, a private family foundation would be a great tool to use. You pass the money inside the family foundation. The requirement is that it has to distribute 5% of its assets every year, and then the assets stay inside. And why that's so powerful, and if you think about my statement about why it helps the family, you can put your kids and or your grandchildren on the board, and not on the board with no job to do or just to pay a superfluous amount, but really to contribute and can create connectivity. Um, One of the greatest outcomes I've seen, I worked with a family who all of them worked in the family business, maybe 15 or 16 of them. But what was interesting is that the family dynamics were not perfect by any stretch. They were just normal people, right? I mean, so many times when we're working with families, they tell us, well, we're not like other families. We have blended families, we have divorces, we don't get along. And what we always try to tell everyone is that's a normal family. A family that has no conflict is really much more of the outlier. The family all had independent plans once the transaction occurred, and everyone was going to receive their piece from the business. However, the patriarch was not going to allow that to happen, and created a very powerful plan to keep his family and his kids together. I'm not going to go into all the details, but I'm going to instead provide you really more with a high level view of how this might be applicable to your situation. So pre-sale, he transferred shares of the company into a family foundation. And once it was sold, the family was able to diversify the shares and avoid paying the long-term capital gains rates. The requirement was that the board, his kids, and then once his grandkids hit 16, had to meet at least 3 times a year to discuss the grant making process to meet their 5% distribution requirement. He paid each one of them as a board member well, but it was all contingent on board meeting participation and then an annual family meeting where they all got together, where the family foundation was not discussed. So let me tell you what happened. 5 years later, I would argue that the children work better together now than they did when they were young children or when they all worked at the company. The inheritance is in a trust and the distributions align with the behaviors and the life stages. And I'm just telling you, the philanthropic planning can be very strategic and technical, and offset a lot of transactional taxes. So please have those conversations and review those options. You also need to think about, with this new administration and with new policy, there's some discussion about potentially removing the step up in basis, which many times business owners use as their strategy, because you have the founder shares at 10 cents or 15 cents, and maybe it's now valued at $10, right? And you have hundreds of thousands or millions of shares depending upon your specific situation. Well, that step up in basis at your death is incredibly powerful, right? We're saving 28 cents per dollar on that appreciation with that step up. But you can imagine the type of wealth that could be destroyed if that was taken away from you. So again, something to think about. The last piece there would be to think about what you'd want your legacy to be. And so many times estate planning documents are cold, and they dictate where it goes. And there's so much strategy involved because we've saved on income tax and we've saved on estate tax, and the financial outcomes are very positive. But I would argue that with philanthropy, or a small part of it, that you can also create some emotional outcomes that will, excuse me, outlive a lot of what those income tax or estate tax strategies helped you with. So the last piece, because that's a very taxing, sorry for the joke, conversation on estate planning, philanthropic, is our final topic today, which is income tax planning. You have a silent partner in your business, and it's the IRS. So if you're thinking or you're in the process of selling all or a portion of your business, and I would say particularly if the shares have appreciated significantly, you should consider the potential benefits of accelerating that sales process. This could have advantages in the event that the capital gains tax rates are raised, and you need to throw in a number of factors before you do that, right? Let's not let the tax tail wag the financial planning dog. There are advantages of running a longer sales process with a larger list of potential buyers for a potentially higher price. There's also the possibility, of course, of a continued upside in the business. And you may find yourself in this current environment in a great cycle where you're seeing 10, 20, 30, 40% growth that you couldn't have predicted. And then the tax implications of several tax transaction structures, an asset sale versus a stock sale. So one strategy to consider would be the election of an installment sale on your shares. So again, if you're considering selling shares of your business and you're concerned about what legislation could be passed in the future and increase on the capital gains rates, electing an installment sale treatment for the sale of these shares could provide you with some optionality. For instance, you might sell the shares of your business either to a third party or to a trust for the benefit of your heirs in exchange for a promissory note. If you elect to treat the transaction as an installment sale, the capital gains tax on the shares sold will be paid over the course of the promissory note as the principal payments are received. So the installment method treatment may also be available for business transactions that are structured as an asset sale, which is generally the transaction structure by buyers. So you're locking in that long-term capital gains rates that we have now instead of a potential rise in the future. As you can see on the slide, we could see long-term capital gain rates move from 20 to 30, even 39.6 for those of you who potentially have $1 million in income, which you may not hit now, but you may very well hit in the year of your transaction, right? Very similar to your estate plan. A lack of planning on the transactional side is going to hurt more than a lack of estate planning because you're actually still around to live through and understand the mistakes that were actually made. So the first thing I would tell you all as business owners is at some point you may have a transaction. You may decide to sell the company. Remember that a lot of the options that are available to you as business owners are not available after there is a signed letter of intent, right? An official letter of intent. And there's some gray area. I would obviously want you to talk to your attorney or your planning team to think about where you sit in the LOI process. But many of the options that we're going to talk about are no longer available once that LOI has been signed. Because again, it comes back to the IRS's disapproval of what we like to call post-transaction transactions. And they view that LOI signing when it becomes official as kind of a stopping point to where you could move assets or move other shares. So if you're thinking about this, contemplating it, or maybe you're even in the process of selling a portion of your business, and particularly if your shares have appreciated significantly, consider the potential benefits of accelerating the sales process. I would tell you it could have advantages in the event that capital gains are raised again. But I would tell you, you have to also weigh it with, is running a longer sales process with a list of potential buyers more important than potentially selling, saving on taxes? Is there continued upside in the business? That's what you want to continue to do, and that's where you find your passion, which are going to have is a lot more impactful than the tax implications of the various strategies. So I want to talk about a few. We've fielded a lot of questions lately from business owners, and if we could go to the Biden potential tax plan. What's going to happen? Will there be retroactive tax legislation? And I think that's really where you all need to focus. In 1993, when the Clinton Tax Act was passed, it actually was retroactive. For those of you who were working then or had your business then, I'm sure you'll never forget that. While we believe the probability is very low, it is always possible. Again, let's plan, not predict. So let's just take the scenario. If capital gains legislation were to be adopted effective as of January 1 of this year, the installment sale treatment that I want you to think about would allow you to defer capital gains taxes into the future. Okay. If, however, capital gains tax rates go up and it's adopted at an effective future date, you may elect out of that installment sale that you thought about. An election out of the installment sale must be made on or before the due date for filing your income tax return in the year in which that transaction actually occurs. So you actually have until October 15th of this year to kind of make that election. Another strategy that you could consider would be a dividend recapitalization. So if you want to generate liquidity, but you're not prepared to sell, and you don't really want to issue any additional shares of your business, which I would say is probably the most common conversation that we have with business owners, I would argue that you could consider the benefits of what we call dividend recapitalization. So in a dividend recapitalization, you take on a loan, the business, and you use those proceeds to pay a one-time dividend to all your shareholders. So if you think about it, if you pay a dividend now, it may help reduce the tax burden on your shareholders in the event that the tax rate on qualified dividends is increased in the future. The current low interest rate environment, again, those 75/20 rates that I talked about, also make this potentially attractive for all of you. So again, something to consider. And then the last piece would be reviewing the entity structure of your actual business. The potential for an increase in the corporate tax rate is a good time for you to revisit the entity structure from a tax perspective. Continuing businesses as a pass-through entity, such as an LLC or a partnership, instead of converting to a C Corp, could be advisable to guard against a potentially higher tax rate. Alternatively, if your entity is already a C Corp, you could then elect the S Corp status, depending on your broader goals. That's a difficult conversation to have from a very high level. So I would strongly encourage you to talk to your attorney as well as your CPA. So I know that we covered a wide range of topics at a rather high level today. Not each one of them are going to be applicable to you and your business, but I hope that you've thought about how some of these could impact you and your family, and maybe you're starting to brainstorm on what you'd want your future to hold. Each one of you has a very unique business. It's been very successful, and each one of you are in a different place on your journey. So each of your goals and action items will be different. And what's fun and scary about it is that there's no one size fits all for any solution. I would tell you, if 2020 has taught us anything, it's that you need to plan and not predict. I think if we were meeting last year at this time, we never would have been able to even comprehend what has happened over the last 10 months, potentially what's happened to your business, what's happened to our country. But I think you would be frustrated long-term if you didn't think about what an amazing opportunity it may potentially be for you right now, and how business friendly the environment may be for you to plan and not predict from an estate planning, philanthropic, and income tax strategy. So with that, I'll pass it back over to you, Katie. Thank you.
Our next presenter is David Hill. He is a senior manager in our tax department at LGT. He has more than 10 years of progressive accounting and tax experience across a wide array of industries, including small to mid-sized companies, as well as more complex corporate structures. He has a wealth of knowledge in financial and tax planning for closely held businesses and high net worth individuals. In addition, David also supervises and trains our current tax staff, along with working with his clients to research any additional tax resolutions. Please welcome David Hill.
Thanks, Katie. Hello, everybody. Thank you for joining us today. I really appreciate you taking the time to join us on this webinar. Today, we're going to talk about the year-end COVID relief that the Congress passed late last year. First, we have our standard disclosure. Okay. Now, the act was actually called the Consolidated Appropriations Act 2021 HR 133. We're going to focus on some of the bigger ticket items today, as the actual act itself is just under 6,000 pages. So there's a lot of information in there. And also, I would encourage you to visit our website for up-to-date information on the COVID-19 relief. Because as this is being kind of analyzed by the IRS, there's a lot of information coming out regularly. So the act actually passed both houses of Congress on December 21st, and then it was signed into law by the president on the 27th. The big news was the stimulus payments were coming out at $600 per taxpayer in this act. And it's also an additional $600 per qualifying child. This phases out at 75,000 for single filers and 150 for people who are married filing jointly. The two items we really want to focus on today that apply to majority of business owners are the Paycheck Protection Program updates, as well as the Employee Retention Tax Credit. So the first one, the big news, is that your PPP funded expenses are now deductible. The IRS had originally interpreted that the CARES Act, the PPP loans from the CARES Act, the expenses used for those to be forgiven should not be allowed as a deduction. Now, this was causing kind of an unexpected potential tax burden for a lot of the taxpayers who had the loan taken out by the CARES Act. And Congress came back in and they made it clear that these expenses would be deductible. Because the IRS had even come out and said that if you thought at any point it would be forgiven, then in 2020 they would not be deductible. And Congress thought that was not what they had intended, and they made it clear. And they actually went further, and they said that your tax basis and tax attributes of your assets will not be reduced. So this effectively will be treated as taxes and income. This is very favorable for taxpayers now that they've made clear that you're not going to have a tax impact from the forgiveness of the PPP loans. They also have directed, Congress has directed that any loan under 150,000 is going to have its own simplified forgiveness application. This should help all parties involved. So with that, the other big update for the Paycheck Protection Program is they've announced round 2 of funding. What's great about this is you're actually eligible to get a second loan, even if you had one initially through the CARES Act. Now, there's different requirements if this is your second loan. The first one is you must have used all of your first loan or will use all of it. The employee limitation has been moved to 300 employees or fewer. And as it's written, you have to have a 25% decline in any 2020 quarter compared to that same quarter in 2019. Now, if this is your secondary loan, it is also capped at a maximum of 2 million. And the payroll amount that's used to calculate your loan is 2.5 times your average monthly payroll for 2019 or 2020. They've actually carved out additional relief for hotels and restaurants as they've been hit particularly hard during the pandemic to use 3.5 times their payroll. And again, those are the requirements if this is your secondary loan, meaning you've already had original PPP loan from the CARES Act. Now, the rules are different if this is your initial loan. Initial meaning you have never had a loan from the Paycheck Protection Program. So for here, it has the original 500 or fewer employees, employee limit. The maximum amount is much higher at 10 million. They've gone on to say specifically who is qualified to receive these loans, and that includes sole proprietors, independent contractors, other self-employed, not-for-profits, including churches. They're really trying to help out too, specifically accommodation and food service. So your restaurants, as they've been hitting particularly hard around the country, and as well as certain news organizations will qualify. Those are the main changes for the Paycheck Protection Program. And if you think you qualify, look through it really, behoove you to look or to contact your tax advisor, see if you can get help with potentially qualifying for that. Now, the second big item we want to discuss is the Employee Retention Tax Credit. This actually came out in the original CARES Act date in March of 2020, but for the most part, it was mostly overlooked because originally, if you had a PPP loan, you could not qualify for this credit. So as the PPP loan was more valuable, a lot more dollars were available, most people overlooked this. But since Congress came back and changed it so there's no longer that prohibition in place, we really need to take another look at 2020 because you can actually go retroactive to the original CARES date and potentially claim this credit for 2020. There is a prohibition though that you can't double dip. So basically you can't take this credit on wages that were also used for forgiveness. Okay, so let's revisit the 2020 rules because again, you're still eligible to go back and potentially get this credit. So as it's written, there's the two people who qualify are business operations were fully or partially suspended by COVID-19 lockdown order and that'd be a government lockdown order, or if gross receipts are less than 50% of the 2020 quarter compared to the same quarter in 2019. So the best example of this for a fully suspended lockdown order would be bars or certain restaurants or potentially some gyms and health clubs. So bars are the best one as far as, most governments have said you cannot be open. So they would definitely qualify for this credit. But one thing, and they're still, if you go to, and the IRS is working on this a lot, they're still going to fully kind of build out what partially suspended means. Because there are scenarios where if you sell certain items and all of your suppliers were suspended by a lockdown order, or say they're manufacturing, they could not manufacture, and then you could not do business, you could potentially qualify as having a partially suspended lockdown order. And the IRS and everybody's still working hard on unpacking kind of everything in the congressional act to make sure we're, applying it effectively. Okay. Now for the 2020 credit, there is a rule that if you have over 100 employees, the only wages that will qualify for this credit are as if you're paying somebody not to work, meaning you're paying them to stay home. Now, if you have less than 100 employees, you are not subject to that same limitation. But one nice thing is they do have healthcare costs counts qualified wages. So if for instance, you have furloughed employees, but you're still paying their healthcare, those healthcare dollars will still be eligible to count towards the credit. Okay, so let's look at how it's calculated in 2020. It's the maximum amount per employee is $5,000. So it's basically a 50% credit, and wages are capped at $10,000 annually. And I wanted to say these credits are they were intended to be taken on payroll tax returns on your Form 941 by reducing the amount of deposits that, for instance, if you were supposed to deposit $10,000 on your payroll return, but your credit was $5,000, you would actually remit $5,000. They're still working on the best way to process these retroactive credits. And I, again, recommend contacting your tax advisor on how to go back and claim these, because obviously 2020 has already passed for most of these quarters. Okay. The other part, big change of the employee retention tax credit is they extended it. Originally, it had ended at December 31st, but now it's going through June 30 of 2021. So Q1 and Q2. Now the qualifications are similar. We still have that fully or partially suspended by a COVID-19 lockdown order, but they've actually changed the gross receipts part of it to where your business only has to be down 20%. And that's the 2021 quarter compared to the same quarter in 19. And one nice thing is by going 2021 to 2019 is theoretically there should be a bigger drop because 2020 was a down year. So we're thinking a lot more people are going to qualify for this credit in 2021. Oh, and the other thing is there's now the employee limit that they had on the 2020 has been moved up to 500. And again, that's where if you have over 500 employees, you're only eligible if you're paying people not to work. And again, healthcare costs still count as qualified wages. The credit is quite a bit more valuable in 2021. So it's now 70% of 10,000 per quarter. If you'll remember, the 2020 was 10,000 per year. So the maximum value here is 14,000. And this is intended again to where when you're filing your 941, you would actually reduce the amount you're depositing to basically take the credit up front by keeping those payroll tax cash. There are scenarios, and the IRS is working on this right now, where if your credit actually exceeds what your payroll deposit should be, there's working on forms to how to claim that credit. So that's the big change. Again, recommend contacting your tax advisor. A lot more people are going to qualify under the 2021 employee retention tax credit than did 2020. Now, as we mentioned earlier, the bill is enormous. We said almost 6,000 pages. So there's a lot of provisions in it. I picked out a few other ones that apply kind of more generally to businesses, but it's certainly by no means an exhaustive list. But they have some further relief from a tax standpoint. We'll just go over those. So business meals are 100% deductible for 2021 and 2022 if it's provided by a restaurant. So this should help the restaurant industry with now those expenses being fully deductible, as they've been limited for a long time. Residential real property. So ADS depreciable life moved to 30 years from 40 if it was placed in service prior to 2018. And that should be a benefit to quite a few taxpayers who rent residential property. Another nice benefit is for FSA account, your flex spending account can now temporarily roll from 2020 to 2021 and 2021 to 2022. And this is a very nice benefit because a lot of people had money they had set aside in there and they were not able to use it, as a lot of medical facilities and other things were closed. So stuff that they would normally do, they couldn't use. So it's nice to be able to move those funds to the next year without any penalty. Okay, see, charitable contributions, you can now deduct up to 100% of your adjusted gross income for 2021. That should help drive more charitable contributions, as it can help reduce your entire tax burden, or 100% of your AGI at least. So that you should see that increase people using deductions. Okay. They've made permanent medical expenses subject to 7.5% of adjusted gross income. It was at 10%. So again, this will help more people be able to deduct their medical expenses. See that also the deduction for energy efficient commercial buildings is now permanent. And they have a 2-year extension for energy tax credits related to building and solar, as well as building residential energy efficient properties. And that overall is some of the bigger items to come out of this act. And again, encourage you, if you have any questions, please let us know. Contact down here. We'll get to those as many as we can. Thank you.
Thank you for joining us for this rebroadcast of our January 28th webinar, Blind Spots. If you have any questions, please feel free to leave a comment, or you can email us at askus@lgt-cpa.com. Don't forget to like and subscribe, and all of our social links are in the description below.